All right, it is high early cash value time, HECV, HECV. So the high early cash value product is great for companies. That's why it was originally rolled out. Corporations that love the idea of cash value life insurance policies, whether they use this for key man coverage, executive benefit planning, retention strategies for their key employees, whatever it might be, they would do all that good stuff, but because the majority of their payment showed up in cash value, it's in the name high early cash value, so you're going to see very, very strong cash values up front. The product did not hurt, or I should say, the payment did not hurt the company's balance sheet because they had the money up front. Now, as the years have passed, some companies have made these products available to everyone. We'll often show this option, and a lot of people don't like it when they compare it to traditional policies. However, like anything, it's a good option to be aware of. So let's take a look here. When it comes to the high early cash value product, a lot of times it's called a high early cash value. Now, the technical name may be called something like a L85, meaning premiums are payable up until age 85. Now, how the product design works. This is the important piece here. Base premium dollars. Do you remember how those function with a traditional whole life insurance policy? What happens in the first and second year? The company overcharges me for the death benefit. Nothing of my base premium shows up in cash value right off the bat. Versus the high early cash value product, there is a difference. If I pay $1,000 in year one, I'll see approximately 90%. If it is a corporate-based policy, that can be as high as 95% in the first year. Early break-even point looks great for upfront cash values. Now, a question that comes up sometimes is, well, hey, I love that, but what's in it for the insurance company? Like, where do they make their money? Because with a traditional whole life insurance product, which is really geared for long-term performance, they give me all the money up front. Well, what happens here, where the insurance company makes their money is they do not overcharge us for the cost of insurance up front. It may buy me a death benefit of $40,000. The insurance expenses are spread out. It is actually more expensive. So what the insurance company is really doing, like how I would explain it, is they're not overcharging me up front. They're saying, I'm going to give you more equity in the early years. However, because I'm giving you more of your cash up front, I'm going to charge you a bit more. I'll just spread it out over the life of the policy. So if you were to look at this side by side with any of the other products over the long haul, it would be fairly weak compared to a traditional policy, for example. So let's take a look here at the actual product, the PUA component, that functions the same. I don't want to skip over it. So if I pay $1,000 in here, you can see that show up, and would get me the same death benefit as well. That's what I saw in the prior two examples. High early cash value. So let's look at the all base premium example first. Here we go. 35-year-old male, just like what we looked at with the traditional whole life product. Up until age 65, he's funding. $50K, this example is 100% base premium. And look at that. He's got about $45,000 immediately, 100% base premium. Now, I've got two highlights here. One, year 5, because he's paid in $250 and he has $250. But look at year 10. He's paid in a total of $500, $50,000 over 10 years, and he's got $499. So this is where that insurance expense that's spread out over the life of the policy, we're starting to see it catch up already. Beginning year 6, it starts to kick in actually, the higher expenses. And then we've got the highlighted in yellow in year 11 is my true break-even point. Then we've got the max blended policy, where we did the exact same thing that we did with the traditional whole life. Blended it, minimum premium, the base premium in this example is, guess what? $5,000. Term rider, everything else going into PUAs, rich equity up front, strong break even, 150 in by year 3, 151 just about in cash value. A high early cash value on steroids here, I would say. Let's look at year 10. Big difference, and this is the part that I'm always interested in, no matter how long I do this. Same product, same company, same age, same individual. By year 10, he's close to $100,000 more in one product simply by redirecting where his money went. That's what we're looking to do. So specifically here, 50K goes in, he's got a $5,000 base premium. There's approximately $600 going towards a term insurance rider, and everything else is going into PUAs, accelerating the cash value growth. If you'd like to see the detailed ledgers, if you work with us and you've obtained a policy, let us know, we can send them to you. Let's take a look long term. Big difference. A lot of money in both of them, but close to $300,000 more in the max blended policy. Overall though, where this is strongest, it's in the name, in the early years because I have more cash value up front. That's the kind of stuff I want to be aware of. If I really need or want more cash value up front, maybe I own a small business and this is an asset on my balance sheet. This becomes very attractive now. Now I've got equity I can use right off the bat. Whatever my plans or goals might be, it's a good option to be aware of. So high early cash value, good option to see. We like to always compare it to other options. For example, we had about $3 million in cash value by year 30. What'd you have on the traditional one? Because these two are at the same company. $3,063. High early, $3,016,000. $50,000 difference. That's the kind of thing to look at. $50,000 isn't that much relative to what I've paid in, but you could also argue it's a whole year's premium payment. So if I see that stuff up front, that's what's going to help me refine the decision-making process and pick the option that's best for me in my personal situation. As always, I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.